Oh, what's going on, guys? Austin here. And in this video, I kind of just want to share with you guys really how to pass your life insurance exam test. I'll be honest with you, I am not the shiniest marble in the box, and I'm 30 years old. I haven't taken a test transparently in so long. Um, I don't even remember the last time that I took a test. So I wanted to just kind of, I took it, my life insurance exam in two different states, one in Colorado and one in Arizona. The reason I did that is because I have my actual driver's license in the state of Colorado, and just a temporary one in Arizona because I used to live in Arizona. So, um, I'm going to pull up this. This is going to be some study material. It's going to be long. I'm streaming this. So this is going to be a couple of hours, but these are going to be all of the terms. This kind of helped me going over and listening to this a ton of times. This isn't going to be a sexy video, but if you want to pass your insurance test on the first try, I'm going to go over everything you need to know in terms of definitions, in terms of just talking about it. I'm going to share a few things that I see inside the test. I've taken it again in a couple different states now. Now that I'm done, I can just get my license in other states without having to actually take the test. But I just want to do this for you guys. I want you to pass your life insurance exam. This is just a life insurance one, so it's not health. I have a term that we will be going over, and some things are going to be going over health. I'm going to kind of skip past those. But for me personally, this worked best for me. This worked best for me on how to listen to somebody create a video exactly like this or very similar to this. And these terms actually helped me pass. The biggest thing and recommendation that I have for each and every single one of you, because of how illiterate and how like not smart I personally am in terms of book smart, like I passed my tests with both. In Colorado I passed it with the 71, and in Arizona I passed it with the 72. So I am not the shiniest marble in the box. I failed my first try. I got a 60. I went on my second try. I listened to a video that I'm making right now. I literally made this type of video for myself, and this is what helped me pass the test. Now, again, a lot of you guys are out there. Like, my best advice to you is 100% don't overcomplicate it. They're going to confuse you. Things are going to get confusing. Um, and just don't worry about it, right? So let's jump into this. This is going to be a long video. I got 18 pages here, as you guys can see. But let's jump right into this. So this is life insurance keywords in simpler terms. This for me helped me pass my test. We're going to go over. I did the PS through PSI, and PSI for me there was no way, no shot. All of the questions that was asked on PSI, you can go do the test prep. I mean, I have the test prep on my iPad. I was getting 95s, I was getting 100s. Like, it was super simple for me to go through the PSI exam, and just do the tests over and over and over again. But I didn't have more than one or two questions that were on my exams. I didn't have one or two questions that had any regards to what I studied inside my PSI exam. So I was getting 95s and 100s. I was like, okay, no shot. I'm going into this test one, being like, this is super easy. I already know all the terms. I can tell you all of the basic principles and annuities and, my state exam. Everybody says on YouTube, which I don't know why, your state exam is 20 to 30%. It varies in different states, obviously. But for me, I had maybe 5% on my test, and that's literally a couple of questions, literally 5 questions, a little bit more, because your test has about 105, at least in the state of Arizona and Colorado has 105 questions. So let's jump right into this. The actuarial department is the team that figures out how much policies should cost and ensures the company has enough money to pay future claims. This is chapter 1. This is the basics, principles of life and health insurance. Now, what I recommend for you guys, while reviewing this and looking at this, what I recommend is I 100% recommend. I know you're listening to it, whether you're driving, at the gym, or wherever the case may be. I recommend you writing it down. There's just something about your mind. If you have an iPad and an Apple Pencil, write it down, take it into Notability. If you just are an old school guy like myself, go ahead and write it on a pen and paper. Actuarial department. It's one thing about listening to this, and there's going to be things that I'm going to have you highlight, because there is going to be things that you're going to see on your test. I know for sure that I'm going to highlight that you're going to be able to want to pay attention to. So, actuarial department, the team that figures out how much policy should cost and ensures the company has enough money to pay future claims. The adjuster. A lot of these terms are common sense. It's how they word the questions when you're taking your exam that's going to confuse you, because they're going to try to confuse you, just like any test in the entire world. Adjuster, the person who looks into claims and decides if they should be paid or denied. Okay. An alien insurer. An alien insurer is one you need to highlight. It's an insurance company based outside the US, but not doing business but doing business. It's a company based outside the US and doing business inside the United States. That is an alien insurer. No politics bringing up, but just think about how Donald Trump, this is how I remembered it, how Donald Trump calls, illegals aliens, right? Illegal aliens. So aliens are outside of the country, but they're doing business inside the US. You will have a question on your test regarding an alien insurer, I would assume. Admitted insurer, an insurance company approved to sell policies in a specific state. Admitted insurer is an insurance company approved to sell policies in a specific state. Agent, obviously, you guys, I'm going to skip over the ones. That way we're not sitting here for 6 hours, because that's just not enjoyable. Broker works for the customer, not the insurance company. There is going to be questions about potential broker, but a different kind of broker, which we'll get into. Can't start coverage, but helps find the best policies. A captive insurer, you will have a question on this. A captive insurer is an insurance company created by a business to cover its own risks. A captive insurer is an insurance company created by a business to cover its own risks. Certificate of authority, a state issued license that lets an insurance company operate in that state. So if you're an insurance company, you need to have a certificate of authority in the state of Colorado, in the state of Florida, in the state of California. So certificate of authority, you're definitely going to see that. The claims department, the team that handles, investigates, and pays out insurance claims. Divisible surplus, extra money an insurance company earns that can be given back to policyholders as dividends. That is a divisible surplus. Highlight that one as well. Domestic insurer, an insurance company operating in the same state where it was founded. A domestic insurer. So they are in California. They are an insurance company operating in the same state as California. A foreign insurer, a insurance company that operates in a state different from where it was originally established. Okay. A foreign insurer is a different, like you can be in Minnesota and sell insurance in Arizona. That is considered a foreign insurer. Independent insurance agency, a business that sells insurance for multiple different companies instead of just one. Insurance, here's a big one. I'm going to highlight this. A insurance is a way to share risk by pooling money from people to cover potential losses. Okay. Oh, these are some of my own terms. This is how I remembered it on the test. So if you guys have any questions, drop in the comment section. I'm going to be able to answer all of those, right? The insured is a person covered by the insurance policy. The insurer is the insurance company, okay? Lloyd's of London, a marketplace where different insurers come together to cover unusual risks. Excuse me. To give you an example, some athletes or surgeons, they insure their hands. because if something happens to his hand, he can't work. So the Lloyd's of London, which is a marketplace where different insurers come together to cover unusual risks, are the ones that kind of take hold of that and deal with that. Marketing division, the department that attracts new customers through advertising, is the marketing division. Some of the ones that are not as important that you won't see much, and I didn't see it all, I'm going to kind of skip past. That way it's not just super overwhelming. Like I said, I created this doc before I even took the test. After I took my first test, I created this, and then obviously I created a video just for myself to hear myself do this and then write this down. And then I ended up passing. And this is what I believe is going to help you pass too. So mutual insurance company, a company owned by its policyholders rather than stockholders. Okay, so this you will need to know. Mutual insurance company is a company owned by its policyholders rather than stockholders. Where stockholders are going to be a different type of company, which we will cover as well. A non-admitted insurer is an insurance company that isn't approved to sell in a certain state. A non-participating policy is a policy that doesn't pay dividends to the policyholder. You will need to know that. Participating policy, a policy that can pay dividends to the policy owner and lets them vote on company decisions. You will also need to know that. Personal producing general agency, we'll skip that. Policy owner, the person who buys and controls an insurance policy. The private insurer, regular insurance company owned by private individuals or businesses, not the government. They kind of just insure themselves. A producer is a licensed person who sells insurance, like myself. If you guys want to join my team, click the link in my description down below. I only bring on anywhere from 3 to 5 agents every single month. As you guys know, everything I've done in my life, I've absolutely crushed. Insurance is going to be this next wave. This is going to be the next career that I'm going to stick with. I've had a lot of good friends of mine sell their companies for 8, 9, and ridiculous amounts of figures. I chose to get into the insurance industry just because this makes the most sense possible. Where else can you build a business long term? It doesn't require you to recruit people. All it does is require you to do personal production, and you can make 10, 15, 20, 30, 40, 50. I mean, there's guys, that I see that are linear to my in terms of the organization, selling $70,000 to $80,000 in a month of policies, an annual renewable premium. So, I mean, it's insane. So if you guys want to join my team, let me know. And we can see if you're a good fit for us. So producer is the licensed person who sells insurance. Proposed insurer, the person whose life or property is being insured. A public adjuster, a claims expert hired by the policyholder to negotiate a better settlement. Okay, so that is a public adjuster. Reciprocal insurer is a group where members insure each other, managed by an attorney in fact. Okay, you're going to want to look into this attorney in fact mode term quite a bit, as well as jumping into the next one, reinsurance. When an insurance company buys its own insurance from another company to reduce risk. Reinsurer is a company that insures other insurance companies. Risk retention group, a group-owned insurer that covers its members' liability risks. Risk retention groups, a group-owned insurer that covers its members' liabilities risks. So that's a confusing one. It's a mouthful, but you are going to need to know these ones. You're going to need to know reinsurance, reinsurer, the risk retention group. Let's do self-insure, a business or person that sets aside their own money to cover potential losses instead of buying insurance. Solicitors, people who find potential customers and set up sales meetings for licensed agents. A solicitor does not need to be licensed. Like how I mentioned before about mutual companies, we're going to be talking about stock insurance companies. Stock insurance company, an insurance company owned by stockholders, aka the investors. So mutual companies are owned by its policyholders. Stock insurance company is owned by their stockholders. Okay. Stock insurance company, an insurance company owned by the stockholders. Surplus lines insurance, special insurance for high risk situations that regular insurers won't cover. Unauthorized insurer, another term for a non-admitted insurer. And then obviously you have your underwriting department, which is the team that reviews applications and decides who gets approved for insurance and at what price. Okay. That was chapter 1. We have quite a few chapters to go. So let's just jump right into this. You will need to remember this first one, the nature of insurance. Adverse selection. This happens when people who are more likely to make insurance claims, higher risk individuals, are more likely to buy insurance than those who are low risk. This can cause an insurance company to pay out more in claims than expected. A hazard is anything that increases the chance of loss happening. Okay. We can get into, a hazard is, for example, a hazard is someone that is known to skydive a lot. That is a hazard because they are putting themselves in a position for risk. Homogeneous exposure units is a group of similar things, people, businesses, or property that face the same risk, essentially just pool their risks together. Indemnify, to financially restore someone to the same position they were in before the loss happened. Okay, so indemnify, you're probably going to want to learn this one too. Highlight it. To financially restore someone to the same position, not better, but to the same position they were in before the loss happened. Okay. Indemnity, the money or compensation given to restore someone after a financial loss or after a loss, not financial, I apologize, just after a loss in general. Indemnity contract, an insurance contract designed to bring someone back to their original financial state after a loss. Again, not better, but the same after the loss. Law of large numbers. When the insurance companies are looking at things, they take into law of large numbers. The more insurance policies a company has, the easier it is to predict the total number of claims and losses. Loss exposure. The loss exposure is the risk of experiencing a loss. Loss exposure unit, any person, business, or property that could suffer a loss. That's a loss exposure unit. Moral hazard. I will definitely highlight this. Moral hazard, when a person's behavior, lifestyle, or character increases the chance of a loss, including fraud. Okay. So moral hazard, when a person's behavior, lifestyle, or character increases the chance of a loss, including fraud. Moral hazard. Morale hazard. Okay, I don't know, to be honest with you. I'm going to say that. When someone is careless or reckless because they know they have insurance. So someone that really doesn't care if they got insurance, and if they die, they know it's going to get paid out. Which might not always be the case. Apparel, the actual event that causes a loss, like a fire, an accident, or a flood. So just think about when you think of peril is a loss. Physical hazard, a physical condition that makes loss more likely, like faulty wiring, increasing the risk of fire, or, a damaged roof not getting done. That's a physical hazard. Primary insurance company. If there are multiple insurance policies, the primary insurance company is the one that pays first. If reinsurance is involved, bear with me, this is a good thing just to listen to. If reinsurance is involved, the primary's insurer is the one that originally issued the policy and then shares part of the risk with the reinsurer. Pure risk, a risk where there's only a chance of loss and no chance of gain, aka a house burning down. This is the type of risk that insurance covers. When there's a chance of loss and no chance of gain. Reinsurance, when an insurance company shares some of its risks with another insurance company. You'll definitely highlight these two. Reinsure, the company that takes on part of the risk from another insurance company. Risk, the uncertainty of a loss happening. You'll have to highlight this next one. Risk avoidance, completely avoiding an activity to eliminate the risk of loss. Risk management, highlight this. Identifying and dealing with risks to minimize potential losses. Risk reduction, taking steps to lower the chances of a loss happening or reducing its impact. Installing a security system, for example, is an example of risk reduction. Risk retention, choosing to accept the risk instead of transferring it to the insurance company, setting aside money to cover potential losses. That's risk retention. So you're essentially saving your own money rather than transferring it to an insurance company for risk retention. Risk selection, the process which insurance companies use to decide whether to cover a new customer and at what price. Risk sharing is spreading the risk among a group of people so no one person bears the full loss. It's really how insurance works. Risk transfer, I would highlight this. Shifting the responsibility for a potential loss to someone else, usually by buying insurance. Self-insurance, setting aside money to cover future losses instead of buying insurance, which would kind of be like a section of reserves. Speculative risk. Sorry, that's a tough one for me. A risk that could either be in a loss or a gain. So you have the two here is pure risk, which is a risk where only a chance of loss and no chance of gain. And you have a speculative risk, a risk that could result in either a loss or a gain, aka investing in stocks or going gambling. That's a speculative risk because that could be either a loss or it could be a gain. These risks are not covered by insurance. Okay. Now I'll tell you the big ones. We'll go through chapter 3. We're honestly cruising through this somewhat. So let's rock and roll to chapter 3. Legal concepts of insurance. Adhesion, an insurance contract that you either accept as is or it's rejected or reject with no negotiating. So again, adhesion, contract of adhesion is either a contract you accept or reject, no negotiating. Agent, the person who sells the insurance, represents the insurance company. Aleatory, the contract is not equal. Some people may pay for years and never claim, while others may claim right away. Aleatory is the contract is not equal. And then I give you an example. Ambiguities, unclear wording in a contract. Apparent authority, highlight that. When it seems like an agent has certain powers, even if they weren't officially given. Okay, so that's maybe not in the contract, but this, when it seems an agent has certain powers, even if they weren't officially given, is an apparent authority. A competent party, someone who understands the contract and is legally able to agree to it. Competent party. People need to be competent in order to get into a contract and be able to legally agree to it. Concealment is hiding important information when applying for insurance. So people can conceal something on their contract or in their application, which is obviously a lie. And that's not good. Conditional. The insurance company only pays if certain conditions are met. So in order for the insurance to pay, just remember that conditional, which means conditions have to be met. Consideration. What both sides give. Money from the insured, coverage from the insurer. Okay. So just remember that, what is a human being when they're getting their life insurance, or when they're getting their life insurance, what do they want? They want to know that when they put their money in, that the insurer, okay, the insurance company is going to follow through with their steps, aka the payout. That is consideration. Consideration clause, the section of contract that explains how much and how often you pay for insurance. Okay. Reasonable expectations is a policy doctrine of a reasonable expectations. If a policy is unclear, it should be interrupted in a way that makes interpreted, in a way that makes sense to a normal person. Express authority, I would highlight. The exact powers an insurance agent is given in writing. So this is in the producer's contract, express authority. The exact powers of an insurance agent is given in writing. Fiduciary is someone who manages money or assets responsible for others. Fraud, lying or tricking to gain money or benefits from insurance. Implied authority, I would definitely highlight this one. Powers an agent has, even if they're not willing, not written in their contract, because that's what they're needed to do their job. Indemnity contract, a policy that helps return you to the financial position you were in before a loss. And then insurable interest. This was a confusing one to me, but this will help you guys. You must have something to lose financially or emotionally for insurance to apply. So, for example, majority of people that have insurable interests are, it's probably your spouse, maybe your boss. If you're a key employee, he's got insurable interest in you. Because if he were to lose you as an employee, how would that benefit the company, or how much would that hurt the company? Insurable interest would be your wife, or your husband. That's going to be insurable interest. Insurable or insurance policy, they're an agreement that outlines it covered, how claims are paid. Misrepresentation, a false or misleading statement, even if it's small. A policy rider is an endorsement, an add-on to a policy that changes the terms. Okay. So policy rider, endorsement, an add-on to change the terms. Reasonable expectations, the idea that a policy should cover what a reasonable person expects it to. Representations, statement an applicant believes to be true when applying. Utmost good faith is both sides must be honest and share important details. Valued contract, a policy that pays a set amount no matter what the actual loss is. Avoided contract is a contract that was never valid due to missing requirements. A waiver, giving up the right on purpose. You'll want to highlight that. A warranty is a guaranteed statement in the contract. If it's false, the contract can be canceled. I would also highlight that. All right, let's dive into Chapter 4, life insurance policy types. I'm going to cover this one, honestly, pretty quick. So accidental death and dismemberment insurance pays money if you die or lose body parts, like an arm, leg, or eyesight due to an accident. Accidental death benefit, ADB, is a lump sum payment to your family if you die in an accident. Sometimes an accidental death benefit might be even paid 2 times or 3 times the amount. Additional premium, extra money you can add to a life insurance policy to grow its value, but there are obviously limits. Attained age, your current age, which insurance companies use to determine rates. Adjustable life insurance is a flexible policy that lets you change your payments and coverage over time. Cash surrender value is the amount of money you get if you cancel your life insurance before it pays out. Cash value, the savings part of a whole life insurance policy that grows over time. Credit insurance pays off a loan if you die or become disabled before paying it off. People put this on their credit cards or auto loans or something like that. Convertible term life insurance lets you switch from temporary term insurance to permanent insurance without a health check. So you can go from a 5-year term or a 10-year term to a permanent whole life. Decreasing term, and all of these you need to be highlighting because you're going to have to go over these multiple times so that you actually know what each and every single one of these mean 100%. Decreasing term insurance is a policy where the payout shrinks over time, often used to cover loans. So every time you pay in that premium, the policy shrinks over time. Because this is decreasing term insurance is, used for example, mortgages, decreasing term insurance, mortgages, because your mortgage is obviously getting lower each and every single time that you make a payment in. So decreasing term insurance, a policy where the payout amount shrinks over time, often used to cover loans, any kind of loans. Endowment contract pays a set amount after a specific time or if the insured person dies before that. Evidence of insurability, proof that you're healthy enough to qualify for insurance. Extended term insurance, a way to keep your insurance active after stopping payments, but only for a limited time. The face amount is the money your policy will pay out when you die. So that's going to be, if people are wanting $100,000 whole life, the face amount is going to be the 100,000. Family income policy is a life insurance policy that gives monthly payments to your family if you die. Family maintenance policy, similar to the family income policy, but it includes a lump sum payout after a set amount of time. So it might pay out for 10 years, and then after the 10 years, you receive a lump sum. Family policy covers multiple family members under one insurance plan. Guideline premium, the highest amount you can pay into a universal life policy while keeping tax benefits. Index contracts are a policy linked to stock market performance with guaranteed minimum returns. Increasing term life insurance, a policy where the payout grows over time. Industrial life insurance, they don't even do really anymore as much. A small life insurance policy with frequent small premium payments. A question that some people might ask in most of these policies, something I want you to write down right now, is you can only pay your premiums either monthly, quarterly, or twice a year, or you can pay a year. Keep that in mind. I'm not going to say any more than that. Increasing term life insurance, I already said that one. It's a policy where payout amounts grow over time. Industrial, aka you can't pay your life insurance policy biweekly, is what I was trying to say earlier there. Industrial life insurance, we already went that. Joint life insurance is your first to die. So joint life insurance is first to die, covers two people and pays out when the first person dies. Joint life survivor is last to die, covers two people and pays out when the second person dies. After that, obviously, there will be no more insurance. Juvenile life insurance is life insurance for children owned by an adult. Excuse me. Level premium, a fixed insurance payment that doesn't change over time. So the monthly payment stays level. Life insurance, a policy that pays money to your loved ones when you die. Limited pay life insurance is a policy where you pay for a set number of years, but stay covered for life. Okay, aka hence the limited pay. Maturity date is when a life insurance policy pays out because the person either died or reached a certain attained age. Not attained, but a certain age. Maturity value is the amount paid when a policy reaches its maturity date. A MEC, modified endowment contract, is a life insurance policy treated as an investment for tax purposes. Okay, this was a really tough one for me to get my head around. So I recommend you guys, looking more into MECs to really fully understand it. Modified life policy, a whole life policy with lower payments at first and then higher payments later. Modified is, for example, because people expect a better income potential later on in the future. Just giving you a hint. Mortgage redemption plan is a life insurance plan that helps pay off a mortgage if you die. Mutual insurance company is an insurance company owned by its policy holders. Non-forfeiture values, options you have if you stop paying for a policy so you don't lose all of its value. That is a non-forfeiture value. So for example, if you stop paying for the policy, what are your non-forfeiture values that are going to be allowed for you to, receive a refund of the cash value or pull your surrender your cash value for, whatever type of insurance that you have. A non-medical life insurance is life insurance that doesn't require a medical exam. Non-participating insurance is a policy that doesn't pay dividends to policy holders. You're going to need to remember that. Ordinary life insurance is a basic life insurance policy with a minimum payout of $1,000. Paid up insurance is a policy that no longer requires payments but still provides coverage, aka paid up. So just think about paid up, like no longer requires payments, but it is paid up. So it is going to pay out whenever you, unfortunately, pass away. Participating insurance is a policy that may pay dividends to policy owners. Okay. So think about it like that. Participating insurance, a policy that may pay dividends to policy owners. Permanent life insurance is exactly what it sounds like. Life insurance that lasts your whole life instead of a set number of years. That would be term insurance. Term would be a particular amount of time. Sorry, someone was Amazon's showing up. Policy term is how long an insurance policy lasts. Renewable term life insurance is a temporary policy that can be reviewed or renewed without a health check. So renewable term life insurance is a temporary policy, aka term life. Anything that says term life is just going to be about a specific number of years. So a temporary policy that can be renewed without a health check. Single premium insurance, a life insurance policy paid with one large upfront payment. Straight life insurance is a whole life insurance with payments due until death. Stock insurance company is an insurance company owned by stockholders. Target premium is the suggested amount you should pay into a universal life policy to keep it active. Term life insurance, which is what I shared with you earlier here, is a temporary life insurance policy that lasts a set number of years. Universal life insurance is a flexible life insurance policy that allows you to adjust payments and coverage. You guys, in this chapter 4, you're going to really want to study what each and all of these mean. I would listen to what I am sharing with you, write it down, and just remember all of your different types of terms, all of your different types of actual types of insurance, because you're going to want to learn this up and down, not only just for your tests, but just for the sake of the products you'll probably be selling. Universal life insurance is a flexible life insurance policy that allows you to adjust payments and coverage. You can change the premiums and you can change the face amount as well. Variable life insurance is a life insurance policy where the payout amount changes based on the performance of investments chosen by the insurance company. So variable life insurance is, going to be a little bit more of your riskier type of, investment style. This does require a series 6 or 7. But yeah, variable universal life insurance is a life insurance policy that lets you adjust your payments and invest in different accounts, meaning your cash value can grow or shrink based on the investment performance. So the big thing that I just wanted to remember was universal life. So universal, when it says universal, it means you can change the face amount and you can change the monthly premium. So when it's variable universal, means you can change and adjust your payments and your investments in your accounts. A whole life insurance is a lifelong insurance policy that has fixed payments, guarantees a payout when you pass away, and builds cash value over time. That is a whole life insurance policy. All right, let's jump into chapter 5 in the life insurance policy provisions, options, and riders. This is probably one of my least favorite and most difficult when it comes to. I don't really need to hear myself, so I'll take these off for a second. So let's jump right into it. So this is life insurance policy provisions, options, and riders. The absolute assignment, when you transfer full ownership of your policy to someone else, giving them total control of all benefits. Okay, chapter 4 and chapter 5, really specifically, because it's going to be the most difficult questions probably on your tests, is you need to listen to this multiple times. Okay, so absolute assignment, when you transfer full ownership of your policy to someone else, giving them total control and all benefits. If used as loan collateral, the original owner can still get back what's left after the debt is repaid. Accidental death benefit rider, extra money paid if the insurer dies in a coverage accident. It usually doubles or triples the pay amount. So if someone has an accidental death benefit rider, okay, accidental death benefit, if they just have that, it's going to pay in an accident. If they have an accidental death benefit rider, it's going to be extra money paid if the insured dies, if it's covered in an accident. It usually doubles or triples the payout amount, the face amount. Accelerated benefits rider lets the insured access part of their life insurance money early. If they have a terminal illness, this reduces the final payout after death. Just remember, if they borrow from it early because of getting into a home or um or like a retirement home or something that they need extra assistance, right? AKA accelerated benefits rider of a terminal illness or something, or whatever the case may be. This reduces the face amount, so they're not going to get what their original policy. They're going to get less than what their original policy said, because of they're getting the accelerated benefits rider. Accumulate interest option. Instead of taking dividends as cash, the policy owner can leave them with the insurance company to earn more interest. The owner must pay taxes on interest earned. Okay, so you will pay taxes on interest earned. Don't think for 1 second that you won't pay taxes on interest earned, but also know that that's awesome. You're going to be able to make more money, potentially, depending on the investments. Assignment clause allows the policyholder to transfer ownership or rights to someone else. Automatic premium loan provision is if a policyholder misses a payment, the insurance company takes a loan from the policy's cash value to cover the premium. This prevents the policy from lapsing until the cash value runs out. So if the cash value is $8,000 or $60,000 or $12,000, it's going to take a policy loan until the cash value runs out to cover the premiums. That is an automatic premium loan provision. Cash option. The policy owner takes dividends as cash instead of reinvesting them. Cash surrender option. If the policy holder cancels their policy, they receive its cash value. However, they lose their insurance coverage. Collateral assignment. The policy is temporarily assigned to a lender as a security for a loan. If the borrower dies, the lender is paid first and the rest goes to the beneficiary. That's a collateral assignment. For example, like a debt collector. Consideration clause. The agreement that the policyholder will pay premiums, and in return, the insurer will provide coverage. So exactly what I was talking about earlier is when people are coming to, when they come to an insurance and they want to get life insurance, they want to make sure that the money that they're paying in, they want to make sure that when they die, that their, the insurer is going to provide the coverage that they're looking for. Dependent riders allows the policy owner to add family members, like a spouse or kids, to their policy for extra coverage. Dividend options. Dividend options are the different ways a policyholder can use their insurance dividends, such as cash value, lowering premiums, or buying more coverage. Entire contract provision states the insurance policy, along with any attached documents, is the complete agreement between the insurer and the policyholder. Exclusions list situations or risks that the policy won't cover. Extended term option uses the cash value of a canceled policy. Extended term option uses the cash value of a canceled policy to buy term insurance for a set period of time. The free look period, you'll want to highlight this as well, but this is a solid one. It's a short time after buying a policy where the policy owner can cancel it for a full refund. It's actually 10 days. So if you want to write that down, if you're writing notes, or if you're listening, just remember free look period is 10 days. The grace period is an extra time after a missed payment where the policy remains active. If the insured dies during this time, benefits are still paid minus any overdue payments. So just think about the grace period is however many days in your state. If you don't pay and you end up dying, you are still going to get the benefits. Your family's going to get the benefits, or your beneficiary is going to get the benefits paid to them minus any of the overdue payments. Guaranteed insurability rider. Okay, this is a big one. You'll want to know these riders. All the riders you're going to want to know. Allows the policyholder to buy more insurance later without proving that they're still healthy. Often applies during major life events like marriage or having kids. Incontestable provision is 2 years. After a certain period, usually 2 years, The insurance company can't dispute the policy's validity. I don't even know. Even if the insured gave incorrect information. Okay, so just remember, um, incontestable provision is usually 2 years, and they can't dispute it. So if the age was wrong, whatever, they just have to go based off the age. They can't dispute it after 2 years. Or if something was wrong in the contract, if they didn't say they had, God forbid, diabetes, which would be horrible if they didn't do, but whatever, right? Insuring clause, the part of the policy where the insurer promises to pay the agreed benefits. Okay. Misstatement of age or sex provision. If the insured's age or sex was recorded incorrectly, the insurance payout is adjusted based on what the premium should have been. Non-forfeiture options choices for how a policyholder can use their cash value if they cancel their policy. 1 year term option uses dividends to buy an extra year of temporary insurance. Paid up additions option uses dividends to buy extra permanent life insurance without increasing premiums. So I promise you guys, as we're going through this, I know this is so much information. This is it's a lot. It's an insane amount. Trust me, I know. However, we're going to get through it. And I promise you, if you're studying for 1 day, 2 days, 3 days, 7 days, 12 days, 15 days, I usually say if you're not getting it done under 14 days, you're really procrastinating. But if you just listen to this video multiple times, take notes on what it is and why it is, and then you can go take the practice tests for PSI if you would like to. I recommend doing it just to do it. Even though how they ask the questions, not even really close to how the tests actually watch the questions. There's some other people out there on YouTube or whatever that have things that you can buy. I'm not going to have any of that because I just, whatever. I just want to make a free video for you guys going over things and what helped me pass. So hopefully you guys get some value. If you guys do, appreciate the thumbs up on this video. Paid up additions. You are going to get this information. I promise you. If I can learn this, I studied for 9 days, in total, 9 days total. So when I was driving, I was listening to my video. When I was working out, I was listening to my video. When I was driving somewhere, listening to my video. When I was doing nothing, I was listening to my video. When I was watching football, I would have my headphones on. Watching football, I'd literally have my headphones on, listening to my audio. So I was listening to this stuff and just getting it down. Free look period, 10 days, yada, paid up additions, yada, insuring clause, pure risk, speculative risk, all sorts of things. So I trust me, you're going to pass your test. You're going to get through this, and we're going to get into life insurance industry, and we're going to absolutely crush it together. If we go with us, which is Nova Life, or if you go with yourself, okay, obviously I'm an independent agent rather than a captive agent. We have higher payouts in terms of premiums, or not premiums, but just annual renewable premiums. Our specific structure starts at 80% payouts or commission. So 80% commission. It's insane. People get paid. So anyways, back to this paid up additions option uses dividends to buy extra permanent life insurance without increasing premiums. But the main purpose of this video is just to help you guys pass your tests. So just remember that. Payer provision. If the person paying for a child's policy dies or becomes disabled, future premiums are waived so that the coverage continues. Payer provision. Okay, just remember, if the person paying for a child's policy dies or becomes disabled, future premiums are waived so the coverage continues. Not just in a child's policy as well. So a loan provision lets the policyholder borrow against the policy's cash value. If the loan isn't repaid, it reduces the payout or cancels the policy. Reduced paid up option stops future premium payments by lowering the coverage amount, but the policy remains active. Reduced premium options uses dividends to lower next year's premium cost. Reinstatement provision allows a lapsed policy to be restarted if back payments and proof of good health are provided. Return of premium rider. If the insured dies within a certain amount of time, this rider pays back all premiums in addition to the original death benefit. Some versions refund premiums if the insured outlives the policy. So most policies go till age 100. If you live till 101, if you've been paying in that, for 30 years or 40 years, some insurance companies give you this return of premium rider, allows you to pay back all premiums plus your face amount. So if your death benefit was $100,000, it would pay you back $100,000 plus whatever your premiums were for the 40 years that you paid into it. Suicide clause. If the insured dies by suicide within 2 years, remember 2 years for the suicide clause, the policy won't pay out. This prevents people from taking out policies right before suicide. Waiver of premium rider. If the policy holder becomes disabled, they won't have to pay premiums, but the policy stays active. Waiver of premium rider. You guys are doing great. Chapter 6, life insurance premiums, proceeds, and beneficiaries. You guys ready? Accelerated benefit option rider. If you are diagnosed with a terminal illness and expect to pass away within 1 to 2 years, this allows you to receive part of your life insurance payout before you die, aka accelerated benefit option rider. Beneficiary, the person or organization who gets the money from a life insurance policy when the insured person dies. Cash value, the savings or investment part of a whole life insurance policy that grows over time. Contingent beneficiary is the secondary beneficiary to the second line to receive the insurance payout if the primary beneficiary passes away first. So the contingent is a secondary beneficiary. Just remember that. If the first beneficiary that passes away, then it's going to go to the proceeds of that individual's death benefit is going to go to the contingent beneficiary. Earned premium, the part of the insurance payment that covers the time the policy has already been in effect. We don't even have to hit this. If you guys want to read it, you can. Fixed amount installment option. Instead of a lump sum, the insurance money is paid in set amounts until it runs out. Okay. A graded premium starts with lower payments that gradually increase for a few years before leveling off is a graded premium. And the reason it's a graded premium is because graded, just remember, graded just means that people expect to have a better income potential in the future. Gross annual premium, the total price of an insurance policy, including all costs like commissions and expenses. Interest factor, how much interest an insurance company expects to earn from the investing policyholder payments. Interest only option. The insurance company holds on to the payouts and only gives the beneficiary the interest it earns. Irrevocable beneficiary, you're going to want to know this. Irrevocable beneficiary is a beneficiary who can't be changed unless they agree to it in writing. Joint and survivor option pays benefits to 2 or more people for their lifetimes. Joint and survivor option. Life income option. The beneficiary gets a guaranteed monthly payment for as long as they live. Life settlement. Selling your life insurance policy to someone else for cash, but for less than the full death benefit. Lump sum option is the entire insurance payout is given at once, minus any debts or overdue payments. Modified premium starts with lower payments for a few years, then increases to a higher fixed amount. Morbidity rate is likelihood of people in a group becoming disabled. Mortality rate, the number of death benefit or the number of deaths in a group over a specific time. Mortality, death. Net payment cost index, a formula to compare the actual cost of different life insurance policies over 10 to 20 years. Net single premium is a calculation insurers use to determine how much money they need to cover policy payouts. Primary beneficiary is the first person in line to receive the insurance payout. Policy proceeds, the actual amount paid out from a life insurance policy after adjustments like loans and fees. Reserves, you're going to want to know this one. Reserves, money that an insurance company sets aside to pay future claims. A revocable beneficiary is a beneficiary that a policyholder can change at any time without permission. Settlement options, there's different ways a beneficiary can receive the insurance, either lump sum, installments, etc. Single premium funding, paying for an life insurance policy in one large payment, so no more premiums are needed. Spendthrift clause prevents creditors or irresponsible beneficiaries from spending the insurance payout all at once by setting limits on how much money is paid out. Surrender cost index is a formula that helps compare policy costs if you plan to cash out your insurance after 10 to 20 years. Underwriting department. We're going to talk about the underwriting department is the part of the insurance company that reviews applications and decides on approval and pricing. Unearned premium is money paid for coverage that hasn't been provided yet. For example, if you cancel a policy mid-year, you might be getting a refund of this amount. Viatical settlement is a person with a terminal illness sells their life insurance policy to someone else for a portion of the payout. Okay. That's viatical. You will need to know that. Viatical, viatee is the person, viatical viatee is the person or company that buys the life insurance policy in a viatical settlement. Viator is the original policy holder who sells their life insurance policy in a viatical settlement. Chapter 7. Chapter 7, life insurance, underwriting, and policy issue. Adverse selection. When more high-risk people... Let me grab my lunch, guys. One sec. Adverse selection, when more high people, those likely to make claims, buy insurance compared to low risk. Insurance companies try to prevent this with careful screening. Age change, the point halfway between birthdays when a person is considered a year older. For insurance pricing, some companies use the nearest birthday. Others use the last birthday. It's usually within 6 months. So they can backdate it typically for up to 6 months. Applicant is a person who filling out the insurance claim application form, or not claim, but the insurance application. Application, the form where the applicant provides personal and medical details for the insurance company. There's 3 parts to that. So write this down. Part 1. Part 1. Part 2. And part 3. Okay. Part 1 is obviously going through the application. Part 2 is medical. Them going over their medical history, if they're diabetic or not. And then there's part 3. Look up what part 3 is. Because I want you guys to remember that. I'm not going to tell you. I want you to remember that. Backdating, which we just said. Attending physical statement is just a doctor's report request by the insurer, just for more medical information. Usually happens to people that are really poor or like unhealthy, or just like are getting big policies, $1 million or $2 million, right? Backdating, changing a policy start date to make the applicant seem younger, which lowering the premium. So if your birthday was, 4 months ago, 5 months ago, when you go to buy insurance, you're going to get lower. You're going to get lower premiums if you put it that you were, instead of 30, you're 29. You're going to get lower premiums. And I'm sorry that I'm eating, guys, but I've been sitting here for I don't even know how long. So let's keep going. Binding receipt, which is an unconditional receipt. You'll need to remember this, is a temporary insurance agreement that starts coverage immediately when the initial payment is made, lasting until the application is approved or denied. So this is an unconditional receipt. When a producer provides somebody with a unconditional receipt, it's a temporary life insurance agreement that starts coverage immediately when the initial payment is made, lasting until the application is approved or denied. So they technically have insurance even before their application is approved or denied. Okay. Buyer's Guide is a booklet that explains different insurance options to help customers make informed decisions. A conditional receipt is a receipt given when the first premium is paid with an application, providing limited temporary coverage under certain conditions. Consumer report. Obviously, we all know credit bureaus. Investigate consumer report, a background check on an applicant's lifestyle, reputation, and financial history. It must follow privacy laws. A credit report is a summary of an applicant's credit history, including debts and repayment behavior, usually obtained from major credit bureaus. Declined risk, a person whose insurance application is rejected. Disclosure form, a required document comparing an old and new policy when someone switches insurance. Evidence of insurability is proof of good health or medical history that shows a person qualifies for insurance. Fair Credit Reporting Act, a law allowing insurers to check applicants' financial and personal history, but requiring disclosure to the applicant. If denied, the applicant has the right to see the report. Field underwriter, the insurance agent who helps complete the application and assesses risk at the initial stage. Free look period is a trial period, which is at least 10 days where the policyholder can cancel and get a full refund. Insurable interest is a financial or emotional connection between people that justifies taking out an insurance policy on someone, aka spouse or a business partner. The MIB is a database that insurance companies use to check an applicant's past medical information. Policy summary is a document that outlines key details of insurance policies such as costs, coverage, and rules. Preferred risk is a person considered a lower than average risk due to good health, lifestyle, occupation, qualifying for lower premiums. That is a preferred risk. Proposed insurer, the person whose life is being insured, often the same as the applicant, but not always. A rated policy, rating up policy that costs more than standard rates because the applicant is higher risk due to health or job hazards. Representations, statements made by applicants that are assumed to be true to the best of their knowledge. If initially false, they can this can affect their coverage. Risk classification is a category an applicant is placed on based on their health, habits, and likelihood of a claim. Standard risk is a person who meets the average risk level and qualifies for normal insurance rates. Substandard risk or impaired risk, as you guys can see, is somebody that has a higher risk due to their health. That's a substandard risk. Or example, if you have crazy, like to do crazy stuff, if you're skydiving all the time, that's a substandard risk. Just because you are putting yourself in the way of, potentially, peril. Underwriter, the person at the insurance company who decides if the applicant qualifies for insurance and at what price. Warranties, an absolute guarantees of truth in an insurance application. If false, they can void the policy. Woo! Guys, we are almost there. Chapter 8, group life insurance. Okay, this one's super, super, super simple, super quick. Blanket health policies. These coverage a group of people. Okay. Unlike regular group insurance, individuals don't get personal insurance certificates. Okay, so just remember that. Certificate of insurance, a document that provides someone has insurance under a group policy. The employer holds the main policy, and employees receive certificates instead of their own policy. So they receive a certificate of insurance. But the individual that owns the group insurance policy, he owns the main policy, and the employees receive certificate of insurance. Contributory plan is a workplace insurance plan where both the employer and the employees share costs. At least 75% of eligible employees must participate in most states. Conversion privilege, the right to switch from group or term insurance policy to an individual policy before the coverage ends without needing to prove good health. It depends on your state, but you're going to have X amount of days. So look that up. It's also going to be in PSI in your state, because if you want to switch from your employers, and I know it's super rude to be eating, so I apologize, guys, but I literally am absolutely starving. I haven't ate today, so I'm like, I need to eat something. The right to switch from group or term insurance, you have X amount of days. In the state of Arizona or the state of Colorado or the state, I know some Californias, they're all going to be different. Or at least I believe that they are. I only took tests in 2 places, and I only learned, actually 3. I didn't take a test in the 3rd places, but I know Washington's, because that's where I'm originally from. I know Washington's list. So they're going, if they're in group life, they have a chance to transition to a whole life policy, an individual one. But just remember, hint, hint, the amount of days that it allows them to do that. That's a big thing to remember. Credit policies, insurance that helps pay off a loan if the insured person becomes disabled or dies. Franchise insurance, a plan for small groups where each individual policy with similar terms. It's used to group and it's too small. It's used when a group is too small to qualify for regular group insurance. Master policy, the main insurance policy of employer holds for the group plan. Non-contributory plan, a workplace insurance plan fully paid by the employer. Employees don't have to contribute to the cost. Persistency is the percentage of the insurance policy that stays active over time. A high persistency rate means fewer people are canceling their policies, which is good for the insurance company. Okay, let's dive into annuities. Annuities is tough. You're gonna want to go over this section as many times as you can. The 403B plan is a retirement plan for employees of public schools, certain nonprofits, and some ministers. It's similar to a 401k, but for these specific groups. A 1035 contract exchange is a tax-free way. Tax-free way. Remember that. Tax-free way to switch from one annuity or life insurance policy to another without triggering a taxable gain. However, you can't exchange an annuity for a life insurance policy. So just remember that. You can't change an annuity for a life insurance policy. Accumulation period, the time when someone is making payments into the annuity before they start receiving payouts. Accumulation units, the value of the money that's put into the annuity minus any fees. It changes based on how the underlying investments perform. Annuitant is the person who will receive payments from the annuity. Annuity units is the units used to calculate payments once an annuity starts paying out. The number of units stay the same, but their value may change. Cash refund option. If the annuitant dies before receiving all of the money they paid into the annuity, the remaining amount is given to their beneficiaries in a lump sum. Deferred annuity, you're going to want to remember this, is an annuity that delays payments until a future date. Often for retirement, it can be bought with a single payment or multiple payments over time. So, for example, if you want to start a retirement plan, I would put into a deferred annuity because you don't need a immediate annuity, because an immediate annuity would start paying out immediately, aka the name, and a deferred means you can defer it for later on down the road. Equity. No, I need a water. Equity indexed annuity. EIA is a type of annuity that offers a guaranteed minimum return plus extra earnings based on stock market performance. So equity indexed annuity Indexed annuity, just think about it as in stock market performance. Okay. Exclusion ratio is a formula that determines how much of your annuity income is tax-free versus taxable. Fixed annuity, remember this one, an annuity that guarantees a set return with the insurance company taking the investment risk. Okay. Fixed annuity is going to be paying fixed amounts. Immediate annuity, an annuity bought with a single premium payment that starts paying out right away, usually within a month. Okay. So just remember, an immediate annuity pays out in a matter of usually within a month. Joint life and survivor option. Excuse me. An annuity that pays income to two people. If one dies, the payment continues for the surviving person. The amount may stay the same or be reduced depending on the option chosen. Life with period certain option. These are where the words get like really difficult, and you're like, like life with period certain option. When you're reading the question that they ask you on the test, it's just like, it's very difficult. So life with period certain option, an annuity that pays income for life, but guarantees payments for a set number of years. If the annuitant dies early, the beneficiary receives the remaining payments. Market value adjustment, MVA, a feature in some deferred annuities, meaning push away annuities, later on down the road annuities, that changes the payout if you withdraw money early. If held until the end of the contract, it works like a fixed annuity. Period certain annuity is an annuity that guarantees payments for a set number of years, even if the annuitant passes away. Period certain. Periodic payment annuity which is a flexible premium. An annuity where you can make multiple payments over time instead of a lump sum. Flexible premium, which is a periodic payment annuity. Principal, the original amount of money you invest in an annuity. Single premium annuity, an annuity bought with a one-time payment, which can start paying immediately or after. So if someone, retires and has 100 grand, they put in a single premium annuity. They buy one and can start paying immediately, or they can choose to defer it as well. Straight life annuity is an annuity that provides income for an annuitant's lifetime, but payments stop when they die. So nothing else happens after that. It doesn't go to any beneficiary. Just straight life is straight life. You're going to have it for your life. When you die, it doesn't go to anybody else. A variable annuity, an annuity where payments change based on how investments like stocks perform. The contract owner, not the insurer, takes the investment risk. Remember that. Selling these requires special financial licensing, like a Series 6 or Series 7. Okay. Wow. Variable annuity. Okay. Remember all the types of annuities, guys. That's going to be huge. Uses of life insurance. Cross purchase plan, chapter 10. Let's jump into it. Cross purchase plan, a business plan where owners agree to buy out a deceased owner's share. Each owner takes out life insurance on the others to ensure they have the money to buy the shares when needed. So cross purchase plan. Entity plan, a business itself agrees to buy back an owner share if they pass away, redistributing it among the remaining owners. Human life value approach is a way to estimate a person's financial value based on how much future income they would have provided for their family. So I know it sounds horrible, but like insurance companies, they do have a human life value approach. Like, what is this human being worth to these individuals based off his income? If you're making 100 grand a year and you're X amount old, they assume of a term 10-year plan, they assume that you're worth $1 million. That's the human life value approach. It's just a way to estimate a person's financial value based on how much future income they would have provided for their family. So-and-so's going to be alive for roughly probably another 20 years. That's worth $2 million because he made so that's how they look at it, right? The human life value approach. Key person insurance, a life or disability insurance policy that a business takes out on an important employee or owner. If that person dies or becomes disabled, the insurance helps cover financial loss. Key person insurance, that is a big one. Okay. Needs approach. This is also a big one. A method for figuring out how much insurance someone needs by looking at their families or businesses' financial needs if they were to pass away, become disabled, or retire. Okay. The needs approach is essentially looking at what do the people need? They need, the kids and the wife need this based off of the needs approach when it comes to insurance. All right. Let's jump into retirement plans, chapter 11. 401k, simple. 403b, just think about a retirement plan simple to a 401k for nonprofits in churches. Okay, that will be a question for you, churches. Defined benefit plan, a pension plan where your retirement pays out, is based on a set formula. IRSA is an Employee Retirement Income Security Act, which was made in 1974. A federal law that protects employees by setting rules for how retirement and health plans must be managed. The KEO plan, I like to say it funny, a retirement plan for self-employed people, allowing them to save for retirement with tax benefits. Okay. There's another term for that, which you'll probably see inside of PSI if you're going to be just skimming over the chapter summary material, which I recommend. Just skip all of the everything and then just go to chapter summary. Boom. KEO plan is a retirement plan specifically for the self-employed. Profit sharing plan, a plan where a company sets aside part of its profits to share with the employees, usually for retirement. Okay. Rollovers, moving money from one retirement account to another without paying taxes on it immediately. A Roth IRA, a retirement account where you put in money after taxes, but both growth and withdrawals after 59 and a half. Okay. This is the major thing to remember. After age 59 and a half in a Roth IRA, money is tax-free. Okay. A traditional IRA is a retirement account where you contribute pre-tax money, meaning you don't pay taxes on it until you withdraw it in retirement. Okay. There's a few things to look at there. 403b, IRSA, KEO plan, rollovers, and then your Roth IRAs and your traditional Roth IRAs. So those are some key points to take away there. The rest of it is kind of common sense. We'll jump into chapter 12. Guys, you guys are doing amazing. If you're still here, see, this is the Washington laws one that I had here. You're going to need to study your state inside PSI. Chapter 12, Social Security. Blackout period, a short time when the main earner dies when the surviving spouse isn't yet able to receive Social Security benefits. Credits, until you earn by working and paying Social Security taxes. When you earn enough, up to 40 credits or about 10 years worth of work, you become fully eligible for all security benefits, including survivor's benefits. Currently insured status, that means you have limited Social Security coverage. Your family can get death benefits, but you might not qualify for retirement or disability benefits yet. FICA taxes, old age survivor, primary insurance amount, PIAs, the basic monthly amount, quarter coverage, retirement benefits, Social Securities Act 1935. I kind of just skipped this one because a lot of them aren't really that like insanely important. I mean, they are, but you don't need to. There's so much material inside this, guys, that it feels overwhelming. And that's why I kind of created this for you, because I want you guys to not be like, holy cow, I just went through all of the chapter summaries and there's so much information. I don't know how people do this in 3 days and 5 days and 6 days and 7 days and study that, whether you're doing it full time or you're doing it part time. Like, it's a lot of information, which is why I don't cover everything in here, because I know that a lot of it is just unnecessary information that you're going to remember. Like the amount of insurance things that I now know that were never questioned in the PSI exams or never questioned on my state exam. It's just, I want to make you guys focus on just the big stuff. The rest, when you're taking a test, utilize common sense. I highly recommend asking yourself the 4 questions. What do these test questions, um, what do these test questions, uh, what are they focusing on? And then not only what are they focusing on these questions, what they're focusing on, but which one makes the least amount of sense, which one makes the more least amount of sense. You're probably going to have 2 questions that are very close to being the right answer. Which one makes the more sense out of that? That, guys, is how you are going to pass your test. If you guys want to rewatch this video, I highly recommend it multiple times just to get the definitions of what the insurance is and what that meant, what that meant, what that made sense doing, what was this, what was that, all of that. If you get that down, which I know you're going to, especially if you listen to this a ton of times, you're 100% no questions, ands, ifs, or buts, probably going to pass your test. My biggest advice to you is take your time. Some people, you have an hour and a half, 2 hours, some states, to take your test, hour and a half to 2 hours to take your test. Take your time. Flag, review your answers. When you review your answers, don't second guess yourself. Go with your gut. Go with what makes the most sense. In your state, there's going to be, I know in Arizona, for example, you can only take the state test 4 times, and then you got to wait a period of 1 year. So just remember that, you have multiple chances. You don't need to pass on your first time. I know you're excited and I know you want to get rocking and rolling, but you don't need to pass on your first time. I say that because I didn't pass on my first time. I got a 60. I'll be honest with you guys. I got a 60 on my first try, but it was good for me because all of the material I was studying was literally nothing really to do with the questions in the test. So it was good for me to see it the first time, and then the second time, obviously, I went into it and passed. But my recommendation to you guys is 1, listen to this video multiple times. You don't need to watch it; you just need to listen to it. And if you write it down, whether you have, like I said, an iPad or if you just have a notebook, I recommend it. No questions, ands, ifs, or buts. You will get it. It's a lot of information. Go to your chapter summaries on PSI. Go to your chapter summaries. Watch the video that they have there, and then review the chapter summaries. Just review the chapter summaries. And then nowadays, leverage ChatGPT. ChatGPT, I live in the state of Alabama. Can you please make a list of 50 questions for me to answer and provide why it's the answer below that I can study? Utilize ChatGPT now because it's the smartest thing in the world to be able to ask your state particular questions, right? Because you're going to have different, I didn't go over specific things like, you can only have 4 tests in the state of Arizona. In Washington, you can take the test 1,000 times, but you can only take it 4 times in the state of Arizona, and then you have to wait a year. So, there's going to be questions like that on your test based off of, state stuff that you're going to want to learn, and you're going to want to know learn it anyways to share with your future agents if you're going to be recruiting or whatever the case may be. But review, watch this video a ton of times. I'm sure that I'll have more material. If you guys have questions, drop in the comment section down below. If you guys haven't already, and smash the thumbs up button on this video, I appreciate it. If you guys want to subscribe. If you guys want to join my team, Nova Life, make sure that we're both a good fit. Like I said, I only bring on 3 to 5 agents a month, if that. You guys can follow me on Instagram. I post all that stuff. My team is we're winners, and this is what we're focused on. I've been in all sorts of industries before, but this is honestly probably the most exciting industry that I've ever been in, and I'm not even a month in. So I am excited. I'm going to be sharing a lot more videos, just experiences. Obviously, I have my shorts that I post, which are just motivational, but I'm sure I'll start posting more shorts as well on my personal page. So I appreciate you guys. Good luck on your test. You're going to pass it. Just you want it, you deserve it. You're gonna go get it. Just do the necessary work that it requires you to be able to pass it. It's not easy, but for some of you it might be. For me, it wasn't. So I had to do a lot of studying and a lot of teaching, or a lot of just reviewing and all of that. So I appreciate you guys. God bless you, and we'll see you in a future video.